You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today, of course, is Wednesday. Today is the day when we speak with Zulfe Ali of Valerity Wealth. How are you doing, Zulfe?
I'm doing great. How are you doing, Buck?
I'm doing okay. So let's start today's show by just, let's talk a little bit about the Monday show, because as we usually do, this was on this product Wealth Accelerator, and specifically, comments from you on this would be really helpful, because I think you're sort of you have experience in the mainstream.
Yeah.
So what do you think?
Yeah, I mean, I'm obviously, one of those guys who is guilty of having a high salary job for most of my working life. So I got stuck on that hamster wheel of high W-2 income, high taxes, limited wealth building strategy that was kind of like, okay, contribute to my 401k, which gets invested in the stock market. And then I've got, my primary residence. So yeah, that's kind of unfortunately, that's kind of the full scope of what many high income earners do, right? Because they're just focused 100% on their job, and it takes up all their time. When they have a brief afterthought about, oh, I should do something on the investment side, it doesn't encompass much more than, contribute to your 401k. Am I allocated okay? And then what's the equity looking like in my house, right? And, it's really been like kind of the last decade where, I started waking up to some of these other strategies that combined, the investment side with tax efficiency and asset protection. I mean, those are all powerful forces that we need to be thinking about when we're developing our wealth strategy. And the way I like to think about it is, if you don't incorporate those to work for you, likely those forces are going to work against you, right? Whether it's going to be inefficient taxes, whether you're going to be exposed on asset protection, all that kind of stuff. So, I think the Wealth Accelerator, to me, it's just a great tool for individuals to construct highly tax efficient retirement strategies, as well as hit the estate planning, and a chance to really grow or accelerate the growth of your investments while being relatively risk, mitigated on the one side, because the insurance company's got tremendous track record and they're pretty conservative, and then taking some swings on the other side when you're borrowing, borrowing from your fully funded policy. So
Yeah.
to me, it's kind of funny because, I always kind of, and I think you've mentioned this before, is like when I've looked at insurance policies in the past, life insurance, it's always been kind of renting, not buying the whole policy. But this is less about insurance. This is more about a tool that makes insurance almost the cherry on top.
Right.
Because you get all these other things that you're like, oh yeah, and I forgot, I also get insurance because of this, which is fantastic.
I think it's great because, the other thing is, like what you said, the insurance is the cherry on top. But if you start thinking about legacy, it's like you can get really creative with this. Like you could be like, well, I got 3 kids. Maybe I pop down $100,000 each, at some point, and let that grow for 20 years, and hopefully I'm still alive, and they get a ton of cash flow off of that. But if I'm not, they just get a huge, they get the life insurance, right? So to me, it's sort of a way to even prevent any of my own potential errors in investing to sabotage their future, right?
Yeah.
So I'm a big fan. I got one of the policies, and some people start thinking about this and they're like, well, I don't have that much money to do it right now. But what I did is I bought probably about 6 or 7 years ago now, I bought a ton of term insurance, but convertible term.
Okay.
So I don't have to go through the health rigmarole every single time, right? What I'd like to do is continue to convert, more and more of this into the accelerator program piecemeal, so that, because you got typically about 15 years on these term policies. So it's like effectively 15 years to potentially convert. And if you've been paying a certain amount on them for a period of time, whatever, none of that's going to go to your heirs unless you die within that period. So, locking in those assets, I think, is a really it's an attractive option. So
Yeah, that's a good strategy. I think, getting the term while you're younger and locking it in and getting the health checks, all that done, getting approved. And then you got the optionality then in the near
yeah.
future or down the road when you feel like you're ready for it. So
Well, the other thing that's kind of cool is that when they do the accelerator, though, like part of it's buying more policies within that policy, and you don't have to get a health check every time. So they just use
right.
your
So once
original
you're
baseline.
approved, you're approved.
Yeah.
Yeah,
Yeah.
that's great.
Yeah.
That's great.
Anyway, all right. Well, let's move on. Let's talk about the economy. What's going on?
Yeah, we had a bit of a inflation surprise last Thursday. I mean, it wasn't that big of a deal, but I think, people had expected, the inflation
Go
numbers to
down.
keep coming down slower and slower. But, the CPI was released, September CPI, last Thursday. So a couple of days after we did our last discussion. And it actually showed for the month of September, a 0.2% rise versus the month of August. On a year-over-year basis, it's still decelerating. So it's, 0.24% now. So previously it was 0.25%. But then on the core CPI, so if you exclude the food and energy, core CPI rose 3.3% year over year versus 3.2 in the prior month. So again, a little bit of a mixed kind of result. I think people were hoping for a really kind of friendly and benign inflation trajectory that just continues to show it decreasing consistently. But it popped up a little, and that kind of spooked some folks in the market. All of a sudden, we got questions of whether the Fed's going to be cutting or stay on its cutting course and all that. I think which I think is way too blown up compared to the small difference that the numbers displayed. But we did see a little bit of action there, and then the other thing
But
that
let me
came,
ask
yep.
you this though, because we're saying it's largely because of shelter bumps in shelter and what else?
It was services. So a lot of the
Services.
services, yep,
So
business services one.
So we know though that the shelter numbers are going to come down because they're in the rear. So I mean, I guess if you think of it that way, unless service prices are going way high, we would think of this as just probably sort of an undulation.
I think that's exactly what it is. I think it's an undulation. I do think, on the services side, they have continued to go high. I mean, think about your tax services, your various different business services that you get. They are actually. I mean, I noticed that insurance, for example, everything seems to keep trending higher and higher. But yeah, I think there was an undulation is probably the right word.
Yeah.
So, and you'd expect that, right? It's not going to be a perfectly smooth decline in inflation.
Yeah.
You're going to see stuff, little bumps along the way, but I think it's the longer term what we got to focus on. So I don't think it changes the Fed's course in any form, although there was chatter that it might, but I doubt that. I think the Fed would look through that pretty much. And then the other economic data that came out on the same day on Thursday was the initial jobless claims, which came out higher than expected. So for the jobless claims that are new jobless claims for the week of October 5th, there was 258,000, which was above the 230,000 new jobless claims that were expected. And it ended up being the highest number since August 2023. So, again, a bit of a undulation that all of a sudden there's a bunch of, more initial jobless claims or initial unemployment than anticipated. But, you've got things like hurricanes, coming up, whether it's Helene or Milton. You've got Boeing strike going on. That's a lot of, people that are not working. So I think a lot of that is kind of also reflected in those numbers. And again, I don't think the Fed will, take the one data point in any kind of material way. They're going to be continue to look for that pattern.
Do
But it does complicate things, right? So on the one hand, you've got inflation kind of going up a little too high, and then the jobless claims are actually coming up a little too high as well.
Right.
So, they're kind of in reverse directions, unideal reverse directions.
So we've got the Fed looking at potentially a little bit higher inflation, but more job losses, and we're not going to
Yeah.
jump. We're not going to jump on that immediately and start yelling stagflation, right?
Correct.
Right.
Correct. It's way too early to be calling that with very few data points.
I bet you some people are though, because that's kind of
Yeah, I know you for sure.
the podcast community typically likes to do a lot of the scare stuff and that. So
Yeah, I mean, I heard, watching various, market commentary, immediately people saying, "Oh, this is going to shut down the Fed's rate cutting policy."
Yeah.
It's like, come on, it's a good way to get headlines though if you go out and
oh sure.
so.
Well,
Anyway, so we'll keep an eye on all that. I think it just makes
noise.
the Fed's
Yeah.
job a little bit more tricky, but at the end of the day, it's not going to change much of what's been planned. So,
Well, how do the markets react?
well, the market, the stock markets, the S&P and the Nasdaq are both up about 1 to 1.5% since we spoke last week. So there has been a rally in the market. The stock market largely ignored those reports. I don't think it was affected at all. It's earnings season, so I think there's been a lot of kind of anticipation that a lot of the companies that are going to be reporting will report strong earnings. So I think things have been trading up there. We have seen that from some of the big banks have been reporting really, really strong earnings, and some of those stocks are up, quite strong year to date, upwards of 20 to 30% year to date performance, which is pretty amazing for big bank stocks. They usually don't move that much, but it signals an environment that it's a healthy economy for banks to operate in. You've got a situation where the short-term rates are getting lower, and long-term rates have kind of stayed at where they were. So the 10-year isn't that much change, but the front end is getting lower and lower, and that's a normal yield curve, right? Lower on the front end, higher rates on the farther end. That means banks can take in cheap short-term capital and lend on a longer term basis on a longer rate. So it's good for them, and it's also a signal that markets are taking banking loans and putting those to good use, whether it's corporates and individuals and that sort of stuff. So the stock market generally doing very well. On the fixed income side, we did see a little bit nervousness right when that kind of inflation number came out. We saw the 5-year, which when we spoke last week, it was about 3.85%, I believe. It hit almost 4% on the day that the inflation numbers came out. So it did kind of spike. The yields spiked up, but since then they've come back down. So they're right back to exactly where we were last week, 3.85%. The 10-year really the same pattern. It's yielding about 4% right now. So nothing dramatic there, other than a bit of a hiccup in between our conversations. But you can see in gold that is up 2.5% since last week. So that's a very big move in a week. And of course, you would expect the inflation data to kind of get people who invest in gold to have even more conviction that they should keep piling in. I suspect there's probably a little bit of a safe haven play there as well, with some of the volatility going on in the Middle East and elsewhere on the geopolitical front. But gold is charging higher and higher every time we speak, it seems like. And
so
finally,
is Bitcoin.
Yeah, Bitcoin up about 11% since the last time we spoke. So, about 67,000 per Bitcoin as of today. So, that has rallied quite well.
What do you think as we head closer to this election? What do you think we're going to see?
It's kind of interesting. The markets really don't seem to be paying much
They don't really
attention.
care.
Because I don't think
Yeah.
that, I mean, first of all, I don't think it's clear like what's going to happen. It is such a, close race that
Right.
it's a flip of the coin, right? Whether it's Harris versus Trump taking the White House, uh, who has control of I think the House. I mean, the Senate is probably going to go to Republicans, but it really seems like the House is a flip of the coin as well. So it certainly could be dramatic if if you get Trump in the White House and then both Senate and House are controlled by Republicans. You could see again, I'm not going to sit here and try to predict how positive or how negative that would be. At this point, both candidates seem like they're trying to outdo the other in terms of announcing fiscally irresponsible policies, right? And then neither of them is talking anything about the big issues, the structural issues with programs like Social Security and Medicare. And so I guess with Trump, if Trump comes in, you'll get some tax cuts, or at least the rates that the policies that are in place today. Hopefully, you'll keep those in place as opposed to letting them expire. I don't know. He's got a lot of talk about tariff proposals and stuff. I don't know.
I don't believe that.
Yeah.
I think he
Yeah.
uses that as a weapon. I don't think he's going to go out there and randomly throw out tariffs at the expense of the economy. I just don't
I suspect he's smarter than that.
Yeah.
And I agree with you. I think he uses it as a good bargaining chip. So when
Right.
when you sit down and negotiate with the other side, they're all freaked out that there's going to be some crazy tariff approach, and maybe they'll come with more realistic expectations to the table. So that's that. And then on the Harris side, my guess is you see a expiration of the tax cut, right? We got when the Trump administration was in place, so those are set to expire at the end of 2025. It's all the bonus depreciation goes away. That's the individual income tax rates go back to the levels of 2017. You got your estate tax exemption reduction goes back to the normal exemption. So I think there could be a variety of things, and I don't know what her tax policies are going to look like, and so it's hard to gauge that as well. So really confusing, and like I said,
I mean,
I
has
think the markets
she even told us what her? I mean, because at least from when she was in the Senate, she did kind of cling to some of these more, I would say, on the socialist side, of sort of Elizabeth Warrenish type tax policies. But I mean, she seems like she's maybe she's tried to moderate that.
Seems like it. At least that's
that's what she says, right?
Communication, right? That's
Yeah.
the communication strategy that that
Right.
her team has been out with. So and maybe Biden was relatively moderate as well, right? So
Compared to her, for sure. Yeah.
so maybe she's adopted his perspective on a lot of stuff. So but no, I haven't seen like
Yeah.
a big tax policy coming out, other than very specific incentives, right? The housing incentive for first-time buyers, low-income buyers, which didn't make
Which
sense.
makes no sense at all.
Yeah, we talked about that last week. A few of these other things, but I think it's unclear exactly what her course will be.
Well, that sounds good. That's about all the time we got today. Thanks for joining as usual, and we'll catch up next week.
Absolutely. Thanks much.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.